Okay, hello everyone, guys. Hello everyone. Good morning. How are you all? Good morning, everyone. My name is Afreen and I welcome you all to today's session. So we are going to discuss Unit 38 today. PPB Module B, Unit 38, Finance to Microfinance Institution, Co-lending arrangement with non-banking financial companies. This is Unit 38, PPB Module B. So we are going to discuss about this topic today. So everyone who is watching this video, just please like and share the video to the maximum you can. And if you haven't subscribed this channel yet, it's a request, guys, that please subscribe this channel and press the bell notification icon. Everyone, guys, just please subscribe this channel and press the bell notification icon. So let's start discussing this topic. The very first and the important thing is the background, right? So first of all, non-banking financial company. What is this non-banking financial company? First of all, the non-banking financial company is any company that is registered under Companies Act 1956 and they are engaged in the process of giving loan and advances and payment to shares, stock, debentures, anything. But it does not accept the demand deposit from the public. So the main difference between a non-banking financial company and a commercial bank is that a commercial bank main business or the main objective is to accept the demand deposit. You can just open the current account or saving account with the commercial bank, and then this money is utilized for giving loans and advances and investments in the market, right? But if we are talking about the non-banking financial companies, non-banking financial companies are those companies which are not registered under the Companies Act 1956. Just a second, everyone. Okay. Sorry for the disturbance, everyone. Okay, so I'm back again, everyone. So we were discussing about the NBFCs, non-banking financial companies. So I was telling you that the main difference between an NBFC, non-banking financial company, and a commercial bank is that the main function of the commercial bank is to accept demand deposit from the public for the purpose of lending and investment, right? But if we talk about the NBFCs, the main purpose of non-banking financial company is actually giving loans and advances and shares and stocks and debentures and everything. They are not in the process of accepting demand deposit from the public, right? Now if we talk about the microfinance and NBFC, so for especially giving microfinance loan, there is NBFC MFI, which is regulated by Reserve Bank of India. Now, what is microfinance? Microfinance means when the services, banking services is given to those individuals who have an annual average income of less than or equal to rupees 3 lakh. So if you are belong or if you belongs to the low income category group, so for that individual, for all those individual, okay, microfinance and non-banking financial companies, MFI, NBFC MFI is actually giving loans to microfinance institution, right? Now, if we talk about the next thing, NBFCs which are registered with Reserve Bank of India. So there are different type of NBFCs which are registered with Reserve Bank of India. Bank may extend working capital facilities as well as term loan facilities to all those NBFCs which are registered with RBI. So working capital facilities, term loan facilities, these all facilities are given to all those NBFCs which are registered with the Reserve Bank of India, right? All NBFCs, including the microfinance companies, they are required to register with the Reserve Bank of India, except for the few exemptions. There are few categories of NBFCs which are exempted from the registration of Reserve Bank of India. So there are different NBFCs which are registered with RBI, like there is NBFC, MFI, MFCs. These are all registered with the Reserve Bank of India. But there are certain class, there are certain companies which are exempted from the registration of Reserve Bank of India. Which are what? Which are exempted from the registration of Reserve Bank of India. Now what are these NBFCs? Like there are microfinance companies which are subject to certain conditions. These are exempted from the registration of Reserve Bank of India. There are ARC, assets reconstruction companies. There are Nidhi companies, mutual benefit companies, chit fund companies, merchant banking companies. So these are all those companies which are exempted from the registration of Reserve Bank of India. Clear? Now, activities not eligible for bank credit. Now there are different type of activities, okay, of NBFCs to which bank finance is not available. There are different type of activities, like there is a bill discounted, rediscounted by NBFCs, investments of non-banking financial companies, current and long-term nature, unsecured loan, inter-corporate deposit, all type of loans and advances by NBFCs to their subsidiaries, finance to NBFCs for further lending to individual, for subscribing to initial public offering, and for purchase of shares from secondary market. These are all those credit, and these are all those activities which are not eligible for the bank credit. So if the NBFCs are discounting the bill or rediscounting the bill, for this bank finance is not available, right? Investment, if the NBFCs want to invest, okay, in any type of company by the way of shares and debentures, for these the discounts are, or the finance, bank finance are not available. If there is an unsecured loan, for this the bank finance is not available. All type of loan and advances by NBFCs, bank finance are not available, right? Now next, prudential ceiling for the exposure of bank to NBFCs. So there are prudential ceilings for the exposure of bank to NBFCs. So first of all, the exposure to single NBFCs, which include the gold company. So minimum, oh sorry, maximum of 20% of bank tier 1 capital. So if there is a single NBFCs, but these exclude the gold company, right? So for this, maximum 20% of banks tier capital can be invested in these type of NBFCs. Now, if there is a connected NBFCs, so if there are the group of non-banking financial companies, so if a bank want to invest in a group of NBFCs, maximum of 25% of bank with tier 1 capital can be invested in these type of NBFCs. If there is an exposure to NBFCs, predominantly lending against the collateral of gold jewelry. Now there is a NBFCs which are especially engaged in the gold jewelry business. Now for this, maximum 7.5% of the bank tier 1 capital plus tier 2 capital can be invested, and the ceiling is 12.5% of the exposure. Aggregate exposure to NBFCs, the bank can fix their internal limit for their aggregate exposure if all the NBFCs are put together. Okay, if aggregate exposures to all NBFCs, which include the gold loan to the extent of 50% or more to their financial asset. So bank should have that internal sub-limits on the aggregate exposure of all such NBFCs. So these are all bank finance to NBFCs, right? Now, there is an NBFC MFI, non-banking financial company, which are especially in the microfinance lending, right? So NBFC MFI, first of all, it is a non-deposit taking NBFC. It is what? It is a non-deposit taking NBFCs. Okay, and it is registered under Section 25 of Companies Act 1956. Now, they have to follow and fulfill these two conditions. They have to fulfill these two conditions. First of all, their minimum net owned fund should be minimum of rupees 5 crore. And if they are registered in the northeastern region, their minimum net owned fund should be 2 crore. So for rest of India, minimum is 5 crore, right? But if they are especially in the northeastern region, the minimum is rupees 2 crore. Qualifying asset share. So qualifying asset means if there is NBFC who want to be classified as non-banking financial company, microfinance institution, for all those NBFC, there is a special condition that whatever your total deposit is, okay, you should not lend less than 75% of your total deposit as a MFI or microfinance lending. Right? It means that you have to lend. If you want to register yourself as NBFC MFI, you have to lend more than or equal to 75% of your total deposit as a microfinance credit. Clear? And if you are an NBFC, normal NBFC, not NBFC MFI, then for you there is a limit that you cannot lend more than 25% of your total asset as the microfinance institution. It is 25% currently, right? So for normal NBFCs, you cannot lend more than 25% of your total credit in the microfinance thing. But for those who is what? For those who are especially classified as NBFC MFI, for you there is the special circumstances that you cannot lend less than 75% of your total